Another earnings season right around the corner, we thought we would help prepare you for it with a 5-part series on investing, a sort of investing 101, if you will. And we kick things off with the price to earnings ratio. The PE ratio looks at the relationship between a company's stock price and its earnings. Many consider this the most important metric when analyzing a stock. So we brought in our investment guru, Doug Flynn, co-founder of Flynn Zito Capital Management, to explain how to take advantage of the PE ratio. I started by asking him why this important piece of information is often overlooked.
That's true. They're always looking at the story, like what is the story behind why I like this stock, I like its products. But when you find that, you have to find out whether the stock is priced accordingly, because as savvy investors know, you want to pick up good companies, but you want to pick them up at a reasonable price.
Right.
And so there's a great measure to determine, is it getting ahead of itself? You can use this for an individual stock. You can use this for the market overall to determine where it is. Is it cheap? Is it moderately priced? Or is it expensive?
And that's when you hear people on TV shows saying this stock is cheap or this is expensive or the market is expensive, which is something a lot of people are saying right now. Let's look at the PE ratio. Let's look at the S&P 500. Which is, a basket of 500 stocks. And let's take a look at the PE ratios over time so we can make some determination about where we are. Now, let's take us through this.
So if you go back from the initial boom from the late 90s into the top of 2000, you will see at the peak there the PE ratio. And really what the PE ratio is you take the price of the stock and you take the earnings. And so simply if a stock has earnings of $1 a share, then if the stock is trading at $25, then the price relative to the earnings is 25.
So the PE ratio of that stock is 25.
Exactly. So that's the peak you hit there in March of 2000. And so the average in history of past is about 18.
Right.
If you're looking forward, it's about 16.
Okay.
So that's where people say 17 is a good number to think about. When you see a number like 25, that's way high, and that's when typically you're going to see a drop, and then you see exactly what happened after 2000 into the low point in 2002.
Fast forward to October 9, 2007, that was a high point in the Dow before the recession.
Correct.
And we were at 17. So it wasn't a given that market was overpriced, even though it was going to go down for the following year and a bit.
And I might argue that was purely related to the financial crisis, which sort of sidestepped this. If you skip over, you're looking now and you're saying, is the market overvalued? Even though the market has run up a lot in percentage,
the PE is actually lower than it was in October of 2007.
It doesn't make it overpriced because it's related to the earnings. If the earnings go up 100%, then the price can go up 100%, and the multiple hasn't moved. Now, that being said, if we continue on and the price keeps going and going and going, but the earnings stagnate, that's where the multiple is going to get out of whack or too high, and you have to be concerned about where you're buying it.
All right, so what do you do with this information?
What you do is, whether you're looking at an individual security or you have a large lump sum of cash and you're saying, the market's up a lot from the lows after the financial crisis, do I want to throw money at it? You might say, well, the market right now is reasonably priced. Going back to that chart, at the lows of 2009, it was on sale.
Right.
The easy money.
Right, and if you did, and that has borne out. If you bought stocks in March of 2009, you'd have done phenomenally well. And that actually explains this bifurcation in our economy, why those people who had money to buy stocks in March of 2009 have done so well.
That's right. And you have to disconnect necessarily the economy from the markets a lot of times. The markets, when things are underpriced, are going to snap back and become reasonably priced. And that's where we are. Now, people think it's overpriced because of where we were, but if you look at the multiple, at least in this measure, it's not overpriced yet. And
but
those
if we
are some
keep,
of the
you said yet. If we keep going on this trajectory, there might be a point where you come into me and say, all right, now we're trading at 18.
Yes.
A PE of 18.
And 20s are where we really start to worry.
Right.
And that's where you start to look at, maybe I won't take a large lump sum of dollars and just throw it in the market at those multiples. Right now, it's reasonable. You're not going to make as much money had you done it a couple of years ago, but it's not like you're buying it overpriced just yet.
We always pay attention to the P. This is why the E, the earnings, become important. So I often talk about corporate earnings on the show, and I'm sure my viewers just glaze over because it can be boring. But the earnings trend is the other side of this equation. If you constantly see companies coming out and warning or missing their earnings estimates, earning less than they did last year, that has to come into this equation.
Exactly. Or on the flip side, if you see them, unfortunately, if they lay off people, a lot of times that translates into higher earnings because their costs go down. You say, of course, if I'm the person who got fired, that's terrible. But if I'm an investor in that company and the company becomes leaner and their corporate profits rise, that's how you make money, because the company's going to earn more, therefore it can support a higher price. And that's what this is all about. Earnings over time drive the market. That is really what drives the market over the long haul. That's why it's really important to not only look at it just now, but on an ongoing basis.
Doug, always a pleasure to talk to you. Doug Flynn is the co-founder founder of Flynn, Zito Capital Management. Tomorrow's part 2 in our series on Investing 101. We'll look at investing in indices like the Dow Jones Industrial Average or the S&P 500. If you've got a 401k, you will not want to miss that. Well, if you're